Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at Spectral AI.
If you find our talks useful, please consider subscribe, like, and comment underneath.
All right.
So today we're looking at a company that is, it feels like it's right on that nice edge, that moment where a medtech company has to stop being just a lab full of brilliant scientists and actually become a business.
It's the moment of truth. And for Spectral AI, the stakes are, they're incredibly high. This isn't some new app.
Right.
We're talking about serious wound care, using AI to see what the human eye literally can't. But, and this is the big but, the stock is in what you'd call the show me phase.
What does that mean in numbers?
It means a market cap of around $53 million, which is tiny. The market's basically saying, cool science, now prove you won't go broke trying to sell it.
Yeah, prove you could survive that leap.
Exactly. Prove the science turns into dollars before the cash runs out.
Okay, so let's start there with the product, the DeepView System. I gotta be honest, at first glance I thought, okay, it's a fancy camera for burn victims.
A lot of people make that mistake. That's kind of like saying an MRI is just for taking portraits. It completely misses what's happening under the hood.
So what is happening?
It's using something called hyperspectral imaging. And you have to understand, the human eye is actually not great at assessing complex wounds.
Really? I would think a seasoned doctor would be pretty good at spotting a third-degree burn.
You'd think, but the data just doesn't back that up. Visual assessment accuracy, it can be as low as 50%. It's basically a coin flip.
Why?
Because we only see visible light. We see the surface. We can't see the biological processes happening, underneath. We can't see the physiology.
And DeepView can.
It sees the physiology. It's not just taking a picture. It's capturing data across the electromagnetic spectrum. It's measuring hemoglobin oxygenation, water content. It's basically quantifying how much life is left in the tissue.
Okay, so it's a data machine, not a camera.
Precisely. And it feeds all that incredibly complex data to an AI, which then gives the doctor a simple map. Green means it'll heal. Red means you need to intervene. It takes the guesswork out.
I do want to push back a little here. Doctors have been treating wounds for a long, long time without this. Is the guesswork problem really big enough for a hospital to spend a fortune on a new machine?
Oh, it's a massive pain point. And it's all about money. If a doctor guesses wrong and waits, that patient could get an infection, sepsis, stay in the hospital an extra 2 weeks.
Which costs a fortune.
Tens of thousands of dollars. And on the flip side, if they operate on tissue that would heal on its own, that's an unnecessary surgery. It's a huge waste of resources.
So it's an efficiency tool as much as a clinical one.
Exactly. And that's where you get these really high switching costs. Once a hospital sees this thing saving the money and improving outcomes, they're not going back to just eyeballing it.
It makes the product sticky.
Very sticky.
But what about the competition? I know names like Moleculite or Swift Medical are out there.
They are, but they're playing a slightly different game. Moleculite is fantastic at detecting bacteria. Spectral is all about predicting the outcome, and they have a trump card.
Which is?
BARDA, the Biomedical Advanced Research and Development Authority.
The government agency. That sounds serious.
It is. BARDA's job is to prepare the U.S. for mass casualty events. They're funding Spectral because if there's a major disaster, they need a tool that can help triage thousands of burn victims quickly and accurately.
Wow. Okay, so that's a pretty powerful endorsement.
It's a stamp of approval that almost no one else in the space has.
All right, the tech is impressive. Uncle Sam's a fan. But now we have to talk about the financials.
Yeah.
Because looking at the Q3 2025 report, it looked like a train wreck on paper.
It was definitely not a pretty headline.
Let's just lay it out. Q3 R&D revenue was $3.8 million, down 54% year over year.
Yeah.
Cut in half. And the net loss grew to $3.6 million. If I see revenue get cut in half at a growth company, my first instinct is to run.
And if you only read the headline, you should run, but you have to dig into why it dropped. This isn't a product failing. It's a business model shifting.
What do you mean?
It's that graduation we talked about. Up until now, their revenue was mostly BARDA paying them to do R&D.
Grant money, basically.
Exactly. They're now moving away from that. They're preparing to actually sell a commercial product, so naturally the R&D money goes down.
So the drop was expected.
To a point, yes. It was also made worse by the government shutdown. That delayed some contracts. They had to lower their full-year guidance from $21.5 million down to $18.5 million.
That feels like a huge risk, though. being so dependent on the government
Yeah.
function.
It's the double-edged sword. BARDA gives them credibility, but it also means their cash flow is tied to federal budgets. That's why this commercial launch is so critical.
Okay, let's talk about that burn. $3.6 million in a quarter. That's what, $40,000 a day for a $53 million company.
It's a lot. The company calls them non-recurring investments. You know, corporate speak for, we're spending a ton of money now to make money later.
But can they afford it? That's the real question. What's in the bank?
As of September 30th, they had $10.5 million in cash.
10.5. They burn almost 4 a quarter. That's not even a year's worth of runway.
On its own, no, it would be terrifying. But they did a raise in October. They sold 4 million shares at $1.90, brought in another 7.6 million.
Okay, so quick math. 10.5 plus 7.6. That's about 18.1 million they're working with.
Right around there, 18 million.
Even so, that's maybe a year and a half of runway if nothing changes. It's tight.
It is undeniably tight, and that's why every dollar is going into DeepView validation, building out 30 systems for final data gathering. They are in pure survival mode until that U.S. launch.
Is there any debt hanging over their heads?
That's the one bright spot, really. The balance sheet is clean, no significant debt. They haven't had to take on any of that toxic financing you sometimes see.
Yet. The clock is definitely ticking. So let's look at the stock itself. The chart has been, well, active.
Active is a very diplomatic way to put it. It's been volatile.
Yeah. It feels like it's trying to build a base around, what, $1.72 or so?
And you see some psychological support right around that 190 mark. The offering price, the institutions that bought in there will likely try to defend that level.
Which brings me to the strangest part of this whole story. The numbers look scary, the cash is tight, and yet institutional ownership is up.
By 8.24% last quarter. This is the signal in the noise.
So what are they seeing that everyone else is missing?
They're not looking at last quarter's revenue. They're looking at the potential revenue 2 years from now. They are buying into this valley of death because they believe the company gets to the other side.
The other side being this SaaS inflection I've read about.
Right. Software as a service. This isn't just about selling a piece of hardware one time.
It's the razor and blade model.
The modern version of it. The hospital gets the device. That's the razor.
Yeah.
But the AI assessment, the actual will it heal answer, that's the blade. They pay every single time they run a scan.
So it becomes a recurring revenue stream.
Which Wall Street loves. And that's what the institutions are betting on. That this isn't a hardware company. It's a data subscription company in disguise.
But to get there, they need one thing.
They need the FDA's blessing, the de novo clearance.
De novo. That sounds complicated. It's not the simple path.
It's not. De novo means from new. They're arguing that they've created an entirely new class of device. There's nothing else to compare it to.
That sounds harder.
It is harder. It takes more time, more data. But if you get it, you've literally written the rules for the whole category. It's a huge competitive moat.
And what's the timeline for that decision?
The company's guiding for the first half of 2026.
So any day now, really. But what if the FDA says no? Or just come back in a year with more data?
That is the big, scary existential risk. That $18 million cash pile, it vanishes pretty quickly if that timeline gets pushed out.
The whole thesis rides on that one catalyst.
For the most part, yes. That and seeing those BARDA contracts start flowing again.
Okay, let me be the bear for a second. Let's talk dilution. They just printed 4 million new shares. If they get delayed, they're going to have to do that again, right?
Absolutely. With about 27 million shares outstanding, every one of those raises just slices the pie thinner for everyone else. It's a real risk.
So let's pull it all together. Amazing tech, huge market, but a terrifying burn rate and a single point of failure with the FDA. What's the verdict?
If you balance all that, I'd score this a 7 out of 10 on the bullish scale.
A 7. That's pretty high, considering the cash situation.
It is, but you have to look at the valuation, $53 million. The wound care market is over $10 billion. If they can capture even a tiny fraction of that, if they hit their own revenue targets of $26 million, this stock is wildly undervalued.
So the market is pricing in failure. And if they just don't fail?
The upside is massive. It's what you call an asymmetric bet. You're not buying this for next month. You're buying it for 2026 and beyond. You're buying that sauce inflection point before anyone else sees it in the numbers.
So the idea is you ignore today's ugly P&L and follow the institutional money.
That's the thesis in a nutshell. They're looking at tomorrow. Retail is often stuck looking at yesterday.
Which leaves a big question for anyone listening. Are you willing to wait for the FDA stamp of approval? Or is the cash burn too hot to handle?
It really is a classic high-risk, high-reward play. The tech is there. The business just needs to prove it can survive.
Thanks for joining us on Smart Wealth with Joshua. We'll catch you in the next one.